You do not need a spreadsheet to understand compound interest. In fact, relying on spreadsheets is often the reason people freeze up and do nothing. I am going to show you how to run the numbers in your head, literally while you are standing in line for coffee. It comes down to two magic numbers, 72 and 114. Divide 72 by your interest rate and you know exactly when your money doubles. Divide 114 by that same rate and you know when it triples. That sounds simple, but the implications are terrifying if you are holding cash, and incredibly profitable if you are holding assets. At 8%, your money doubles in 9 years. At 3% inflation, your purchasing power gets cut in half in 24 years. These rules turn abstract percentages into concrete timelines. Once you see the timeline, you cannot unsee the urgency. Here is the issue I see constantly. We are bad at thinking in percentages. If I tell you an investment returns 8% and another returns 12%, your brain says, okay, one is a little bit better than the other. It feels like a linear difference. A 4% difference feels like 4 pennies on the dollar. It feels negligible. But compound interest is not linear. It is exponential. And the human brain is notoriously terrible at visualizing exponential growth. We evolved to understand linear threats, a lion running at us, not exponential threats like inflation eating our savings, or exponential opportunities like dividend reinvestment. This is why we need shortcuts. We need a translator that turns percentage yield into time. Time is the currency we actually understand. Today, I'm going to give you that translator. We are going to break down the rule of 72 for doubling, the rule of 114 for tripling, and the darker side of these rules that tells you exactly when you will go broke if you ignore them. Before we get into the mental math, I want to make a quick request. If you want to stop guessing about your financial future and start engineering it, go ahead and subscribe to the channel. I don't sell courses and I don't have a Discord group. I just want to make sure you are getting the best ROI on your time. And the best way to do that is to make sure you don't miss these breakdowns. All right, let's start with the most famous shortcut in finance, the rule of 72. Let's start with a pop quiz you can do in your head. If you have an investment paying you 10% a year, how long does it take to double your money? The intuitive, linear part of your brain might want to say 10 years. 10% times 10 years equals 100%, right? That is the simple interest trap. It is logical, it is clean, and it is completely wrong. Because money makes babies, and those babies make babies. That is compounding. If you wait 10 years at 10%, you haven't just doubled your money, you have actually more than doubled it, technically, but the math gets messy. We need a way to know the exact doubling point without pulling out a scientific calculator. This is where the rule of 72 comes in. It is the back-of-the-napkin trick that wealthy people use to instantly assess a deal while everyone else is still looking for the calculator app on their phone. Here is the mechanics of the rule. You take the number 72. That is your constant. You divide it by your annual rate of return. The result is the number of years it takes to double your capital. Let's run the numbers. If you are getting a 6% return, take 72 divided by 6. That gives you 12. It takes 12 years to turn $10,000 into $20,000. Now, let's bump that return up to 8%. 72 divided by 8 is 9. Suddenly, you have shaved 3 whole years off your doubling time just by finding 2% more yield. If you manage to find a 12% return, 72 divided by 12 is 6. You are doubling every 6 years. Think about that for a second. At 12%, you double your money 4 times in 24 years. At 6%, you only double it twice in that same period. The difference isn't double the profit, it is exponential. This formula comes from the natural logarithm of 2, which is roughly 0.693. But 72 is used because it is easily divisible by 2, 3, 4, 6, 8, and 9. It is a number chosen for convenience, but it is startlingly accurate. Now, you might be thinking, okay, Tom, doubling is great. I love doubling. But you need to pause, because this rule is a double-edged sword. It doesn't just measure asset growth, it measures debt growth and purchasing power destruction. If you have a credit card with a 24% interest rate, run the rule. 72 divided by 24 is 3. That means every 3 years, the amount you owe to the bank doubles if you aren't paying it down. If you ignore a $10,000 debt for 6 years, it doesn't become $20,000. It becomes $40,000. The bank is using the rule of 72 against you. And this brings us to the most painful application of this rule: inflation. Most people ignore inflation because 3% sounds low. Let me show you why 3% is actually a financial disaster waiting to happen. We often hear central banks targeting 2 or 3% inflation. It sounds negligible. You might think, who cares if my coffee costs 3% more next year? That is pennies. That is the linear brain getting tricked again. We tend to view inflation as a tiny tax we pay annually. We do not view it as a cumulative erosion of our life's work. But we should. If you are keeping your savings in a checking account earning 0% interest or under your mattress, you aren't preserving wealth. You are actively losing it. The rule of 72 works in reverse here. Instead of doubling your money, it tells you how long it takes for your money to lose half its value. We call this the halving time. It is the concept that keeps financial advisors up at night, and it is the reason you cannot just save your way to wealth. Let's do the math on your cash. If inflation is running at 3%, take 72 and divide it by 3. That equals 24. That means in 24 years, your money buys exactly half of what it buys today. If you retire at 60 with $1 million, by the time you are 84, that million feels like 500,000. You haven't lost a single dollar bill, but you have lost half your lifestyle. Now, what happens if inflation ticks up? We saw inflation hit 6, 7, even 9% recently. Let's use 6% as a conservative average for a high inflation era. 72 divided by 6 is 12. In just 12 years, your purchasing power is cut in half. If you are saving for a house down payment and you keep the cash in a shoebox during 6% inflation, in 12 years you need double the cash just to stand still. This is why the safe option of holding cash is actually a guaranteed loss. The rule of 72 proves that safety is an illusion. The psychological twist here is that inflation is invisible on a day-to-day basis. When your stock portfolio drops 10%, you see red numbers, you panic, you feel the loss. When inflation runs at 4%, your bank balance stays the same, you feel fine. But the rule of 72 tells us that at 4% inflation, your money halves in 18 years. It is a slow, silent crash. It is the boiling frog metaphor. By the time you realize your money doesn't stretch as far, the math has already done the damage. The rule of 72 allows you to make the invisible visible. When you see a 3% inflation print in the news, don't think 3%, think 24 years to halving. When you see 6%, think 12 years to halving. It changes your urgency level instantly. It forces you to look for investments that at least match that rate, just to tread water. So, what is the protocol? You use the rule of 72 to set your hurdle rate. Your hurdle rate is the minimum return you need just to stay in the same place. If inflation is 4%, Your investments must generate 4% after taxes just to maintain purchasing power. Anything above that is real growth. Anything below that is a slow bleed. When you look at a high-yield savings account offering 5% and inflation is 4%, you aren't making 5%, you are making 1%. The Rule of 72 clarifies the battlefield. It stops you from celebrating nominal gains that are actually real-world losses. You need to shift your mindset from making money to beating the halving time. If you can double your money faster than inflation halves it, you win. If not, you lose. But let's stop playing defense. Let's stop worrying about just beating inflation and talk about actually getting rich. Because while doubling your money is good, tripling your money is where the magic happens. Most people stop at the Rule of 72. They calculate the double and they are happy. But the wealthy don't just want to double. They want to know when they enter the exponential curve that creates dynasty wealth. This is where the rule of 114 comes in. If 72 is the rule for the cautious investor, 114 is the rule for the empire builder. And the difference between doubling and tripling isn't just one more times your money. It is the difference between retiring comfortably and retiring on a yacht. Let's look at the math that almost nobody talks about. The common belief is that tripling your money takes forever. If doubling takes 10 years, tripling must take, 20? 30? It feels like it is too far out to plan for. This is why so many people get discouraged and trade risky options. They want the triple now, because they think the safe route is too slow. But because of compounding, the third X comes faster than you think. The gap between doubling and tripling isn't as wide as your intuition suggests. The rule of 114 is the shortcut for tripling. It works exactly like the rule of 72. You take the number 114 and divide it by your interest rate. That is your timeline to turn $1 into $3. Why 114? It comes from the natural logarithm of 3, which is roughly 1.098, multiplied by 100 and rounded up for easier mental math. It is accurate enough to change how you view long-term holding. Let's run the numbers on 114. Say you are getting that same 8% return in the stock market. 114 divided by 8 is 14.25. So in roughly 14 years, you have tripled your money. Remember, with the rule of 72, you doubled in 9 years. So wait, it took 9 years to get the first double, from 1 times to 2 times, but it only took about 5 more years to get from 2 times to 3 times? Not exactly. That's not how the math works. But it shows you that the acceleration picks up. Let's look at it differently. At 10% return. 72 divided by 10 is 7.2 years to double. 114 divided by 10 is 11.4 years to triple. So in just over 11 years, you have 3 times your initial capital. If you are 25 years old and you invest $10,000, by the time you are 36, you have $30,000. By the time you are 47, that $30,000 triples again to $90,000. By 58, it triples again to $270,000. Notice the pattern? Tripling is powerful because the base gets so big so fast. Here is the twist that catches everyone off guard. The difference between a return that doubles your money and a return that triples your money over the same time frame is massive. Let's say you have 2 investors, Alice and Bob. Alice aims for a return that doubles her money every 12 years, about 6%. Bob aims for a return that triples his money every 12 years, about 9.5%, using Rule 114 reversed. Over 36 years, a standard working career, Alice doubles her money 3 times. 2 times 2 times 2 is 8. She has 8 times her money. Bob triples his money 3 times. 3 times 3 times 3 is 27. He has 27 times his money. A relatively small difference in annual percentage, 6% versus 9.5%, resulted in Bob having more than 3 times the wealth of Alice at the end. The rule of 114 reveals the extreme leverage of slightly higher returns over long periods. It shows you that settling for okay returns leaves millions on the table. So how do you use this? You use the rule of 114 to set your long-term wealth targets. If you want to turn $100,000 into $300,000 for a specific goal, say buying a vacation home in 10 years, you can work backward. 114 divided by 10 years equals 11.4. You know immediately, without a spreadsheet, that you need an asset generating roughly 11.4% annually to hit that goal. If you look at the S&P 500 and see it historically does 10%, you know you are going to fall slightly short unless you add more capital. It gives you an instant reality check on your goals. It stops you from hoping and starts you planning. You can look at an investment and ask, will this help me trigger the rule of 114 in my desired time frame? If the answer is no, you either lower the goal or increase the savings rate. The math doesn't care about your hopes. Now, before you go running off to tattoo 72 and 114 on your forearms, I have to tell you the secret that most simplified finance videos leave out. These rules are liars. Well, they are benevolent liars, but they are approximations. They work beautifully in the normal world of 5 to 10% returns. But if you step outside that zone, if you are looking at super high interest rates or super low interest rates, the math starts to break down. And if you rely on them blindly in those edge cases, you are going to miscalculate your fortune by years. We need to talk about the accuracy gap and the nerdy cousin of Rule 72 that nobody invites to parties but is actually the smartest guy in the room, the rule of 69.3. There is a myth that math is always precise. In this case, 72 is a fudge factor. As I mentioned earlier, the true mathematical derivation for doubling is based on the natural log of 2, which is 0.693. So technically, we should be using the rule of 69.3. But try dividing 69.3 by 7.4 in your head while walking the dog. It's a nightmare. So we round up to 72. For returns between 6% and 10%, 72 is surprisingly accurate. The error rate is tiny. However, the further you get from that 8% sweet spot, the more the rule drifts. If you are looking at a high-yield bond at 15%, or a credit card at 25%, the rule of 72 starts to underestimate how long it takes. It gets a little optimistic for investments and a little pessimistic for debt. It's not a fatal flaw, but you have to know it exists. Here is the quick fix if you want to be a sniper with your mental math. For every 3 percentage points you move away from 8%, adjust the rule by 1. If you are looking at a really low rate, say 2%, you are 6 points below 8%. So you subtract 2 from 72. Use the rule of 70. 70 divided by 2 is 35 years. That is extremely precise. On the high side, if you are looking at an investment returning 20%, maybe a small business or a risky venture, you add to the number. 20% is 12 points higher than 8%. So we add 4 to 72, since 12 divided by 3 is 4. Use the rule of 76. 76 divided by 20 is 3.8 years. The exact answer is 3.8 years. Using 72 would have given you 3.6 years. Is that a huge difference? Not really. It's a couple of months. But knowing how to tweak the rule makes you feel like a wizard. It reminds you that this is a curve, not a straight line. But there is a bigger problem than just the number 72. It is the assumption of steady return. The rule of 72 assumes you get exactly 8% every single year like clockwork. Bank accounts do that. The stock market does not. In the market, you might get plus 20% one year, minus 15% the next, and plus 10% the year after. The average might be 8%, but the geometric return, the money you actually keep, is lower because of something called volatility drag. When you lose 50%, you need a 100% gain just to get back to even. The rule of 72 doesn't account for the messiness of real life. It is a vacuum calculation. So, psychologically, you must treat the result as a best-case scenario for volatile assets. If the rule says you double in 9 years, in the real stock market, it might take 10 or 11 because of the zigzag path. Always add a buffer of patience to your mental math. This brings us to my favourite practical use of these rules, the scam detector. You can use accuracy limits to spot fraud instantly. If someone pitches you an investment promising 1% per day or 5% per month, use the rule. 5% per month is 60% a year, ignoring monthly compounding for a second, which makes it even crazier. Rule of 72 says 72 divided by 60 is 1.2. They are claiming you will double your money in 1.2 years. If you compound it monthly, it's actually doubling in months. If anyone promises you a doubling time of less than 3 or 4 years without massive risk, run away. The rule of 72 anchors you to reality. When the math says this doubles in 6 months, your brain should scream Ponzi scheme. Legit businesses rarely double capital that fast. Use the rule to protect your downside just as much as you use it to project your upside. If the doubling time sounds too good to be true, it is. So, let's recap the toolkit we just built. You have the rule of 72 to estimate how fast your wealth doubles, and how fast debt doubles against you. You have the reverse rule of 72 to see how fast inflation cuts your life in half. You have the rule of 114 to calculate the dynasty building wealth of tripling your money. And you know how to adjust these numbers so you don't get fooled by edge cases. These aren't just parlor tricks, they are filters. They allow you to look at a mortgage rate, a savings account yield, or an index fund return and instantly translate percentage into years of my life. That is the ultimate financial literacy skill. It stops being about math and starts being about time management. I want you to try this out this week. When you see a percentage, whether it's on a credit card offer or a news report about inflation, do the division. Divide 72 by that number. See how it changes your perspective. If you found this breakdown helpful, do me a favor and hit the like button. It helps the algorithm find other people who need to learn this math. And let me know in the comments, what is the doubling time of your current portfolio? Run the numbers and drop them below. I'm curious to see the range. Thanks for watching, and I'll see you in the next one.